Focus. Ideate. Innovate. Enable.
Leaders from some of India's largest banks and housing finance companies converged at the second edition of the India Mortgage Leadership Conclave held recently in Mumbai. The theme for this year's conclave was Housing Finance, the Next Growth Opportunity. Relevant stakeholders from the housing industry came together to address the immediate challenges facing the industry, including the liquidity crunch and trust deficit prevailing in the lending ecosystem and the prospects for the sector's growth in the medium and long term, given India's massive urban and rural housing demand. The event kicked off with a welcome address by Mahesh Mishra, CEO, India Mortgage Guarantee Corporation.
On behalf of IMGC and CNBC TV18, I welcome all of you to the second edition of the India Mortgage Leadership Conclave, IMLC. When we met in this room the last time, GDP estimates were 7, 7.5. Incurable optimists were speaking of 8. If I were to just put it diplomatically, shoulders are a little shrugged right now, and I think expectations are a lot more damp. So is it really all doom and gloom? Well, the straight answer to that is no, especially in the medium term. Now, why do we say so? Well, to begin with, through this turbulence, a lot of players, a lot of stable players have actually managed to grow. And not only have they managed to grow, they are pretty optimistic about sustaining this growth rate in the years to come. Second, and more importantly, if we look at the government and the regulator, they have not sat as mute spectators. If we start with the regulator, we have had 5 rate cuts in the last 12 months, 5. Second, housing finance regulation has converged with the Reserve Bank of India, and that has 2 sets of benefits. Firstly, we can expect more consistent, uniform regulation that is likely to create a level playing field. In any case, with 58% of mortgage originations being done by banks, there was a case for regulation to move to the RBI. Secondly, this also leaves NHB with far greater bandwidth to play the sponsor role that it is interested with playing. And we already see a slew of government initiatives where NHB is the principal anchor. The RBI also, in response to a demand for liquidity and absence of direct funding lines for NBFCs, formed a securitization committee. The committee, in turn, has presented a set of very impactful recommendations with a lot of international precedents and rationale for why certain changes should be made to the securitization ecosystem. If some of them are implemented, we can certainly see a fillip for securitization, which in turn will provide NBFCs with the fillip that they require in order to kind of grow. If we come to the government, and there have been a series of measures, I'll probably focus only on a few, but the Pradhan Mantri Awas Yojana, or the Housing for All scheme, is arguably one of the world's most successful affordable housing schemes. And if you just look at the first half of this financial year, the PMAY sanctions are in excess of 53,000 crores. In response to the need for NBFCs needing liquidity, the government also set up a partial credit guarantee scheme, which would provide a first-loss guarantee to state-owned banks so that in case they decide to buy NBFC pools. Now, this is certain to expand their risk appetite and make them evaluate pools that they were previously shy of examining. In order to address the supply side, we also have a 10,000 crore contingency fund to help last-mile projects that are currently stuck for completion. And project completion is imperative in order to bring the consumer sentiment back. So if you look at all the stakeholders in the industry, there is a certain acknowledgement and responsiveness to the need to bring housing finance and housing back, because the linkages with other parts of economic growth are obvious to all. As a mortgage guarantee company, we have a vantage ringside seat because we get to interact with the entire range of stakeholders. And we also have a certain set of observations in the last 12 to 15 months. Firstly, the top 5 lenders are extremely confident of growth. Interestingly, all 5 of them have a different outlook on how and what they wish to grow. Secondly, there has been a lot of talk around affordable housing. We certainly see the tone getting a lot more sincere in the last 12 to 18 months. Almost every lender, regardless of segment, regardless of size, is extremely keen to fine-tune their affordable strategy. What makes this richer is the fact that it is not just a business opportunity because demand in Tier 1 and Tier 2 cities has slowed down, but there seems to be a genuine commitment to furthering financial inclusion. However, when we have conversations with lenders, the discussions still center around portfolio quality, liquidity, and distribution. Technology and analytics are still largely spoken in the context of underwriting seamlessness. If we see the kind of rigor that technology and analytics have in, say, the unsecured asset space or running cross-sell programs, I think we have some way to go before the same level of focus sets into the secured side. And as people grow their affordable book, which means onboarding nearly 40 to 50% of customers who are having their first borrowing relationship, the need to deepen analytics and the need to examine credible alternate data sources will be paramount. Needless to say, technology will play a very vital role in terms of creating the enabling platform on which all of this will ride.
Housing is one of the fundamental human needs, and for a developing economy like ours, both housing and real estate are extremely important sectors as they set the trend for economic growth. As employment and consumption levels go up, the demand for housing goes up as well. So as new jobs get created, more people should buy new houses. Real estate also happens to be the larger employer of workforce in developed economies. In case of India, it's the second largest employer in the country. Housing finance as a sector stands at around 7% of India's GDP. In case of developed economies like US, Denmark, Sweden, Spain, Germany, the numbers range from 40 to 70%. So we have got a long way to go. So while India's economy's GDP could increase by twofold to $5 trillion in the coming decade, that's what the government is aiming for, the housing finance industry, we believe, has to grow at a much faster pace. So the question is India ready to witness the growth in the housing sector? Well, in my view and my colleagues' view, India is very well poised to see a major growth in housing finance in the coming decade on account of multiple reasons. One is the economic growth rate itself. We are currently amidst a slowdown, and as Mahesh was rightfully pointed out, that the growth rate has come down from 7% to a lower number, and it might take another 12 to 18 months for the growth rates to pick up. Despite this, I strongly believe that we shall continue to be one of the fastest growing economies in the coming decade and are well poised to see growth, especially in the housing finance and the more manufacturing sectors. As far as demographics is concerned, on account of the sheer demographic profile of our population with a median age of 28 years, we are going to have the largest employable workforce in the coming decades. It's a much abused notion about how India demographic dividend will pay off. Hasn't paid off as yet. But if you can get more people working, and there should be more consumption, more house buying, and hence more demand for housing finance. India is also seeing a clear move towards urbanization. We have, on an average in a year, 11 to 12 million people are moving to urban regions year after year. The urban population of the country is expected to be 580 million by 2030. They all need houses. This migration is being driven by better employment opportunities in the urban sector. With the urban population increasing and earning better, the demand for real estate and housing finance is obviously bound to go up in the coming decade. So urbanization should push housing. And obviously, as Mahesh pointed out, the government of India has rolled out multiple initiatives over the past few years to augment real estate sales and housing finance, granting infrastructure status to affordable housing. The initiatives have helped developers to raise capital at lower cost. They have allowed external commercial borrowings in affordable housing. So private equity and venture capital investments in the sector, for example, have reached 1.47 billion between January and March 2019, for which data is available. RERA has come in. The landmark law has been enforced to bring more transparency and accountability at the developers and has hopefully led to increased customer confidence. GST rates which were 12%, and initially 12% and subsequently 5%, have significantly benefited the sector, and especially the consumers, and especially in the affordable housing segment. Tax exemptions have been given, so middle class for the first time home buyers will now get enhanced deduction of 1.5 lakhs, over and above the existing deduction of 2 lakhs on account of interest on housing loan for a house valued up to 45 lakhs. So, another set of exemption. RBI has taken a very big step by linking interest rates to external benchmarks. So as long as the repo rates are going down, the customers can avail of floating rate loans, and hopefully there'll be a faster transmission of interest rate changes because of this change brought about by Reserve Bank of India. Yes, the transmission has not happened to the extent RBI likes, but over a period of time, hopefully it should come through. The government has launched the Pradhan Mantri Awas Yojana in 2015, providing interest subsidy on loans to various sections of the society so that their housing demands can be met easily, and the shortage amongst the urban poor can be taken off. There has been a special fund created for delayed projects in real estate. I think Mahesh talked about that, which is a special fund of 20,000 crores, especially for affordable and mid-income housing. And these are the projects which are 60% complete, and non-performing assets, etc., etc. So they have given a funding boost to even incomplete projects by creating this particular fund. I guess it's in the process of getting created as we speak. So with the position that India is in, and the thrust which is being given by the government, I'm fully confident that the housing finance sector will contribute in a big way towards economic growth and the $5 trillion dream of the government of India.
Let me begin by asking you, Mr. Verma, since you've had the advantage of having a bird's eye view as being the regulator of the housing finance companies at your stint at the National Housing Bank. How has the housing finance system evolved over the last few years? Is it conducive to be able to meet the needs with the growing urbanization that India is witnessing?
4 factors. Say, for example, one is a development of the market infrastructure, which has been very, very important. Number 2 is institution building, which is the number of players in this sector and different categories of players. The banks, regional rural banks, cooperative banks, specialized housing finance institutions, NBFCs. So institution building in this sector has been tremendous, and it has grown over the years. Banks got excited about doing housing much later. In fact, they came in about 2003, 2004. And from that time on, there's been no looking back for them. And they have taken a much larger share of nearly about 65, 67% today. And housing finance companies accounting for about 30%, which used to be reversed earlier. So there has been huge amount of, I would say, cross-fertilization, exchange of expertise, and the combination of different kinds of institutions coming in to do housing finance. The demand has been there for everybody to see, and which is attracting a lot of the lending institutions. There has been market infrastructure, like we had SARFAESI, for example, which ensured early easy foreclosure of the mortgages, one of the important early risk mitigating measures for the lenders. The second, on top of that, we had SARSAI, which is today a portal of all kinds of information, both of the property and the individuals. We had credit bureaus coming in, even for the micro borrowers, there's credit bureau. Then more lately, we have very landmark legislation under RERA and IBC. So these are all market infrastructure, growth and development. So we have market infrastructure development, product diversification, we have robustness of the market, risk mitigation, and institution building.
But Mr. Kalyan Sundaram, you have access to all of the data. Let me start by asking you, that there is a need for building a lot of housing units to meet the demand that is going to be coming in with growing urbanization is a known fact. Is housing finance able to keep pace?
In the general sense of what we see, the trend of demand is continuing to grow. That's clearly what we are seeing, and it's growing. The demand has continued to grow, and it has grown by a certain basis points that have remained range bound. The supply side of things have clearly tightened, and they have tightened for a variety of reasons. One is the risk perception that these companies have taken on is very different from what they were just a few quarters ago. But they are turning back positive in the way that we are seeing, because we are seeing the need for them to lend more to be able to improve their balance sheets as well. The demand continues to be in the 15-20 basis points uptick every year, and this is just seen by what we see at the Bureau, the kind of reports that come to us in terms of inquiries, that continues to show that kind of uptick. So I would say that in order to just meet that level of demand, that's the pace at which the supply side also needs to grow. And it's not obviously growing because risk factors and risk awareness is a lot higher than it was before. So if you ask a broad number of where that needs to be at, that's the number that I would peg it at.
Okay, let me also bring in the housing finance companies here that we have on the panel. Starting with you, sir. What has been your own experience? Has demand not taken a hit because of the slowdown? Are end users still coming on, signing the check?
So Ritu, I must admit here, we've built in capacities almost 3 times in the last 6 months to 12 months, and we just believe we are 1 year late. And that much demand we see. My personal view, and that's what we hold in the company, that with 9.9% of mortgage to GDP, with the kind of thrust which government is doing on housing for all, there is no question of demand slowdown. What we are facing is probably a bump on the road, and we'll have to deal with that. And largely, what's happening is I think the consumer's choice has moved from buying a WIP product to a finished product. And that is actually, in our view, is that's creating a problem on the supply side also, because when developers had done their cash flows, certain sales velocity was expected during the construction phase, which is not coming forth, and that's where they're stuck. So if you really ask us, our view is it's just a timing issue. Country cannot see a slowdown in demand. It's a matter of a year or two when, but certain structural things has to be dealt with, especially as Amitabh had mentioned. We have to get out of this crisis of what developers are going through. Yeah. The projects need to be completed. We have almost 3.5 lakh units which are incomplete today, and they cannot be left at this stage. Because if that's not done in the next 2 years or 3 years, it can have some cascading impact within the housing finance industry as well.
All right, to meet that need, Mr. Tripathi, I'd like to ask you, the last 1 year or so, we all know has been very tough, especially for housing finance companies from NBFCs. Has the situation on the ground improved? I mean, is liquidity, given all that the government has done, what RBI has done, whether it is securitization norms being relaxed, whether it is giving a thrust on affordable housing by way of priority sector lending, have things improved for you?
Actually, if I say about my company, I don't see much of a problem, but on the ground you see, in last 1 year, when September 21st, 18 started, after that, the acute liquidity shortage was there, but gradually the banks started lending. The top-rated HFCs were getting the funds earlier also from capital market and from the banks, but other HFCs were not getting. Today, if you ask, all HFCs which are AA rated and above, they are able to get funds a little bit at a higher cost. I can't say they are getting at the same rate which they are getting at 13, but the funds they are able to get. But those HFCs which were serving the low-income affordable housing sector, are BBB, BB, or A, they are finding it difficult. Of course, the quantum-wise, their disbursement was not very high, but they are not able to get that much liquidity even today also. As regards the securitization is concerned, from September onward to March, most of the companies, whatever the pool they had available, they sold to the banking system. Now, to generate the fresh pool for selling, you need the funds. They sold and they paid their liability also because monthly interest and so many things were coming. So they could not generate sufficient fund to create more pool. That is the situation. The liquidity is improving, but if you say liquidity has come back normal to pre-September 80 position, no.
I see. Would you like to comment on that from State Bank of India's point of view as well? Have banks really been able to come in and capture some of this gap that has been left behind by housing finance companies and NBFCs because of what they've been going through?
Yeah, we are already there, and as we are all, YOY growth is close to 20%. We are going to touch that. And regarding what he said, securitization, the NBFC and HFCs, they are short of funds to create a pool or take the pool.
Have you been able to take advantage of that?
Yeah, we are going for the co-origination model, and we have suggested to the RBI for permitting the HFCs also for coordination with the bank. And that will improve and fill up the gap quite a substantial extent.
Since we're completely out of time, just winding up thoughts from all of you, what is the one thing in housing finance that excites you more as you think about the future? Starting with you, Mr. Kamal.
So very clearly, affordable housing. It's expected to grow at 30%, and today it forms 10% of the total housing finance market. It's expected to be about 20%. But I'm also taking this opportunity to caution the industry because affordable housing has open risks both on the supply side and the demand side.
Yeah.
So we have to ensure that we don't have these project or delays, etc., on the affordable housing because the viability of the developer will come into question. So supply side has to be dealt with well. Parallelly, the demand side, and this is where our belief is that besides being a responsible lender, you also play a quasi-advisor role as to how much of leveraging the customer should take.
Responsible lending.
Yeah. So, while it looks exciting, but we have to tread with caution there.
Mr. Tripathi, affordable housing for you as well?
As Mr. Anuruddha has told, that any lending has to be the responsible lending. It should be assessed, number one. Number two, in affordable housing in low income and 15 lakhs to 45 lakhs to project. Both are different. In second case, the supply side from builder is there. In first case, which are below 15 lakhs, largely it is self-construction. So their risk is minimal, but the lender has to be very responsible. We would like to continue to focus on this, but many lenders like banks, for them, a big opportunity to affordable housing finance is there.
Okay.
It will continue to grow, but the caution should always be there. There should be no exuberance for going ahead.
No over-exuberance as well. Mr. Verma, what is the one thing in housing finance that excites you the most?
Yeah, develop long-term funding for the sector.
Okay.
And that's something which is typically required for the housing finance. You have to get the pension and provident funds in some way. You have to develop those kinds of instruments. Long-term funding is very important, and that's going to hold the HFC in a good state always, and the banks. If they have long-term funds, I think it becomes more affordable, it becomes more sustainable, and it has to be on tap. So there has to be excited players to invest in long-term paper. There has to be a long-term debt market, and that's something which is missing. This is a very important piece of the mortgage industry. The rest of it, of course, my other panelists have talked about.
Mr. Shrikant?
Housing is a dream, and the bank enters into a long-term relationship with the customer. So apart from the housing, affordable housing, I think the reverse mortgage, once it opens up, that will opens up a huge opportunity for all the players in the market.
All right. Last word from you.
Yeah, well, I'm a big believer in the India story, and part of the story is also going to be this. We cannot grow as a country without all segments growing, and clearly this is one. The two words, or the four words that I would use is, let's be careful about irrational exuberance. Let's not call out rates that we think we can achieve. Let's be realistic about what we can do. The other thing is also be cautiously optimistic in terms of what the pragmatism is around. We are a factor of what happens around the world. We are a factor of what happens around us as well. So we will always grow. We are a country that has never stopped growing. But let's be cautiously optimistic in terms of the way we grow, and let's not be irrationally exuberant. That's the way I would put it.
Thank you, all of you, for your time here. It's been wonderful speaking to all of you.
Focus. Ideate. Innovate. Enable.